anytime you try to consider an economic topic, never mind two of the biggest ones, which are growth and inflation, draw a sine curve somewhere on a piece of paper or in your mind. Some people learn differently. But for me, if you have growth, the sine curve looks like this, with the top end being 3% and the low end being 0 or minus 1%. Whereas if you have something like inflation, currently that is, the amplitude is lower, right? So the top's going to be plus 2% and the low end could be minus 1% or something like that. So that's what inflation's done. Last year bottoming here, it'll top here around Q1 and then start to decelerate a little bit. Maybe it'll decelerate a lot. How do you get it to not decelerate a lot? You get somebody like Ben Bernanke to eviscerate the US dollar like the British just did the pound. So again, that could happen, so we'll have to read and react to that. Currently you have a strong dollar, which only raises the probability that once you peak on core PCE inflation, that you start to go down a little faster against what are going to be very difficult comparisons in the second and third quarter next year. So that's what I'd say about inflation. Again, it's just something people tend to get. Most of these people that are worried about inflation now are the people that were worried about deflation at the lows of this sine curve, right? They're right here. Oh, deflation. Oh, inflation. Oh, deflation. That's called chasing your tail. Don't chase your tail.
Are dividend cuts a high probability outcome in the next 6 to 12 months as growth continues to slow? Isn't that what's creating demand for U.S. equities?
Their demand for U.S. equities in the last 3 months has been falling, right? So you got U.S. equities in the last 3 months is down 1.5% for the year to date. You have some passive aggressive return of about 4% now. What's created the demand for yield is growth.
Yeah, I think that's maybe
growth slowing. Yeah, anything that is going to give you a replacement currency with less volatility or replacement return with less volatility on that return. That's been why low betas outperform from a year-to-date perspective. That's why bonds have outperformed stocks from a year-to-date perspective. That's why gold, notwithstanding its most recent correction, is pretty low volatility comparatively speaking to something like owning the financial stocks. So again, people do in a growth slowing environment on the growth curve as you go from here to here, which is basically this is our call right now. It's really simple. GDP is at 1.2% year over year right now. And as it slows towards 0, you're going to want to own these kinds of exposures. You want to own safe yield. Safe, not get me an MLP that can't pay its dividend in 2 months yield. Not that. Safe yield. Safe yield, put an S there. You want to own low beta. You want to own gold. You want to own long-term bonds. That's what we like. Am I missing anything? Utilities. This is the portfolio for this because it was a portfolio for this. The illusion of stabilization largely in Q1 had to do with one of the mother of all stimulus that a country could have provided. And it's not something that everyone in the U.S. talks about. I mean, they'll talk often about how the Fed went dovish quickly in March, and that was a big part of the bailout of the U.S. stock market. But what the Chinese did was unprecedented in both size and scope.
Well, so a lot of things really happened that was very favorable for, if you go back and rewind the tapes on 2016, which we obviously try to do as much as possible. A lot of things happened in the February to March timeframe that were all very positive for inflation. So the dollar peaked in late January. The dollar peaking coincided with the reversal of capital outflow pressure from China because capital outflows in China, at least over the last 18 to 24 months, have been largely driven by prepayment of dollar debt and keeping foreign earnings abroad to effectively to wind down yuan carry trades. So now that those two things happened, you had the dollar peak, you had China, the currency story sort of go away, and then you also had fiscal monetary policy in China, that impetus being as high as it's been really in the last 4 to 5 years. In the 2016, those three things have really sort of coalesced to perpetuate a really bullish backdrop for inflation. Now, if there's no way we're going to get all three of those things again, and the probability that we actually go the wrong way with the Europe imploding and with China policymakers sort of either pulling back or just maintaining the same pace of stimulus is really great.
Just so I think it might take like 2 minutes to explain this. Like when Darius speaks, he speaks mathematically. So again, we want you to be better than your competition. We want you to beat the market. Obviously, that means you got to be smarter than both your competition and the market. One way to do that is to speak accurately from a mathematical perspective. So when Darius says or makes a statement like it is slowing on both a sequential and a trending basis, okay, so that's a rate of change mathematical statement on 2 durations, okay? So that's really important. So I want you to be able to talk that way once you understand being that way. So again, this morning I cited Jordan Ellenberg's math book, which is actually a very good book. Darius is the one who actually gave it to me, not surprisingly, because Darius educates himself every single day in math, and again, I think you should too. So again, start to think about multi-duration and multi-duration rate of change analysis. So when you have something, when he says on a sequential basis, that basically means on a month-over-month basis. When he says on a trending basis, that represents, that's the year-over-year trend, multi-quarter trend, okay? So a sequential data point, I wrote this morning, I mean, a trend is not tying 2 dots together. You can't just take 2 sequential data points and call it a trend. Some people do. Some people don't even tie it to anything. They'll just look for one thing, and they'll say, oh my God, look at that thing. That's how people do macro, and that's how they do macro. They don't have any context whatsoever to put the sequential month-over-month move within the trend, which is a year-over-year trending data series. And that's the base pack of where I want you to get. Of course, this is all in the sine curve. So again, the sine curve is the trend. Where is the trend? On a multi-quarter basis, it's going down from a growth perspective. So when he said that the data points have been slowing on both a sequential and a trending basis, that means the shorter term month-over-month is corroborating with the larger trend. These larger trends are very difficult to stop. Again, these are not things that people should, again, not all curves are straight lines is another thing to think about. So when people start to tie together one and 2 dots or one data point to itself and make a straight line with it, I mean, that's absurdity. I mean, that's really, if you did analysis that way, I would be trying to find a way through HR to get you out of here in fairly short order as an analyst. You just wouldn't be relevant. It's the same thing as coming to the field without your cleats on and being viciously hungover with nothing to say. I mean, I got no time for that. I want you to be a lot better than poor athletes and poor analysts and certainly these journalists that kind of opine all day long on what's actually going on. So again, let's together, and again, I appreciate all the feedback because this is really getting me to take the time to really boil down really simple things. They're simple, but they're critical. And again, that's something that we want you to hydrate with every day. We want you to be ready to play. If you're a guy, got to shave, come to work, look good, feel good, and have at it. You're going to have a better day than doing otherwise, I think.
Absolutely.
What's your take on financials pulling off good earnings quarters so far with interest rates so low?
Look, the way that a financial works, actually, good time to go to the board. I'm missing my black marker, guys, by the way. So a financial company. So if you're one of these banks in the Excel app, or if you're more of a regional type, you're in the KRE, U.S. regional. These ones have the big money center banks like Bank of America, J.P. Morgan, Citigroup. All these companies, when they report earnings, by the way, a lot of these companies are reporting non-GAAP earnings, non-generally accepted accounting principle numbers. But these companies, when they report earnings, they have a choice. It's called loan loss provisions. So again, they can provision for the emergence of negative cyclical realities, or they don't. And if they don't take on enough provisions for bad debts and bad credit, anything, let's just call it #bad, they can report any earnings number they want. You know that, right? So what really matters to me when I look at these banks in particular is that they're not only showing and issuing a massive amount of credit to consumers at the end of a cycle, going down the FICO file, super low quality credit. We've shown this multiple times in previous macro shows. We're showing you, redefining subprime, really. They're giving a ton of credit and they're not provisioning for the credit. Now that's why they have good earnings. So because they know that there are a bunch of monkeys there that watch CNBC that'll say, oh, look I own this stock at 10 times earnings and 1 times book.